Hi, everyone. Dr. Fasanya. People know me as Bayo. I'm a pulmonary critical care physician. I'm also the CEO for Dr. BDZ Capital. We're very excited to bring this opportunity to you today. For those that are following us, they know that since April, since we closed on the 129 units apartment complex in Fort Smith, we've had trouble finding deals that work, right? Based on the economic climate and the interest rate, it's very difficult to actually make the numbers work. And I'm sure Brian and Richard can attest to that. When I saw this deal came across my desk, I was very excited. And the more I look into the deal, the more excited I got. Joining us today is going to be Brian from Elevate Group. So they're co-sponsor. And so he's going to be talking about some of the finances towards the end of the presentation. I also have our business analyst for Dr. BDZ Capital, Richard Scott. He's also going to give us his opinion on the deal, and then he's going to chime in as we go through the presentation. We have to do this disclosure, right? So we make sure, just to tell you that we're not financial advisor, we're not lawyers, we're not CPAs, and you need to do your own due diligence. Yep. Yeah. So I already introduced myself a little bit. And like I said, I'm a physician first. I'm a pulmonary critical care doctor. I work in the ICU and lung specialist, but I've always been entrepreneurial. I have an entrepreneurial mindset, and I tried different type of investment strategies. I do stocks, crypto, startup companies, venture capital, and at the end, I settled down on real estate as my base way to preserve my capital while also getting good return. So I bought my first 8 units in 2019. And before that, I was investing as a limited partner. However, I got the fever, right? The bug of I want to try what it looks like to be a landlord. So I bought 8 units. And since then, we've accumulated about 883 units with about $143 million under management. This includes some self-storages, multifamily. We also have some oil and gas investments. And also we have 3 offices. So it's been a great journey. I would like you guys to join us on this. So I'm going to give it to Richard just to talk a little bit about himself and how he collaborates with Dr. BDZ Capital and what he thinks.
Absolutely. Thank you, Dr. Fasanya. As alluded to, my name is Richard Scott, and I'm investor relationship here at Dr. BDZ Capital, as well as business analyst. I've been an entrepreneur now for the greater part of a decade. I started in healthcare. I own and operate a few different healthcare entities, including a preventive telehealth company, some family practice clinic, as well as my complexity lab. I got into real estate just over half a decade ago because I realized that it was a great way to mitigate tax burden while building financial independence, as well as growing our portfolio with assets. Since then, I've also started a nonprofit for my native country of Jamaica, BMP, where I facilitate and support students in rural communities with their needs for transportation as well as meals for school. I'm here today to discuss this opportunity because I believe that it fits great into the purview of what investors are looking for. And just to echo Dr. Fasanya's point, the climate with interest rate being so high has been it's been really difficult in the effort to find opportunities that is not just beneficial to investors, but also has the opportunity to be successful long-term. So again, thank you guys for being here, for expressing interest in being a part of this opportunity, and we're looking forward to share with you more about this opportunity and more in the future.
Thanks, Richard. So we also have a member of the Elevate team here. Let him introduce himself, and then he's going to be talking later on about the financial analysis. Go ahead, Brian.
Yeah, thanks, Bayo and Richard. Excited to partner up with Breathe Easy Capital on another deal. If you guys were with us on the last one at Watercolors, a few of you investors got in on that deal, and it's going really well. We're excited to be capturing quite a bit of appreciation there, forced appreciation, and that's what Elevate has been doing for the past 20 years. George and Eric are the co-founders. George, Eric, and myself are the three principals at Elevate. I sit here in Northwest Arkansas, Rogers, actually. George and Eric, my partners, are in Dallas. As you can see, we built out quite a team the past years. George and Eric come from a background of construction, which is super important when you're getting into the multifamily space. As Bayo knows, the CapEx piece is a very important piece, and that can range millions of dollars. So we have in-house construction. We brought on property management last year as well. So we're very vertically integrated. We have over 6,000 doors right now across the country: Arkansas, Oklahoma, South Dakota, South Carolina, and Florida. So we're investing in landlord-friendly, business-friendly areas. We're looking all over the country. We're not investing in California, the Northeast. We're investing in solid markets like Northwest Arkansas and like this deal we're presenting in Kansas City. That's a little bit about us, and we're really excited to be partnering with Breathe Easy again on another deal.
Thanks, Brian. Yep. I actually went to many of your in-person events. So we've talked in person, and so I really feel good about the team. So
yeah, absolutely. And I'll touch briefly on our other two partners here on Madison. So Archstone and Aspen Funds. Aspen Funds is local to Kansas City. They're boots on the ground there. They, like Bayo, they invest in oil and real estate, and they're our boots on the ground partner there. And Archstone, Chris Salazar, very heavy investor in the Midwest and specifically apartment complexes. And he was the one that ended up sourcing this deal for us. So we have a really good team here. And that's what we really like about the commercial real estate and apartment complex space is it takes a team. It takes a team of active sponsors and you as passive investors to really take down these large apartment complexes. And we have a really strong team coming in here for Madison.
yeah.
Just briefly touch on, that's the asset there, beautiful asset. As you can see there, Madison, but Archstone, they have an in-house property management as well. So we will, as the owners, have the control of managing this property ourselves. So property management isn't a very profitable business, but it's a control aspect. So us as owners, we like to have that control aspect of managing expenses, managing income expectations. So we feel really good about Archstone here.
I see this, thank you, Brian. I see this as a current trend in real estate right now. So we also actually brought management in-house on our last deal. It's just very difficult to find proper management team that care about your property like they care about their own. So at the end of the day, I love in-house management also because you're able to have more control, right, over the operations. You're able to see every single thing, no nickel and diming, which it has happened before, where everything you want to fix, you have to pay another 10% on top of it when you have a property management. So there's a lot of transparency when you have it on your own. Go ahead. So I'm going to go over the investment overview. So this is basically the crux of this presentation right here. So what is this deal all about? So this is a 200 units townhome community in Kansas City. So Kansas City has about a population of about 200,000 and it's the second largest city in Kansas. And one very important reason why we love this deal is that it's located, the #1 rated school district is located in this area. During my clinicals, it's going to be probably 2011 or so, I actually did my clinical rotations in Kansas City. It was in Overlook Hospital. It was in St. Luke's Hospital. So we were able to understand this area during that time, and it's always been a coveted area. Until today, it's where when you be like, oh, when I finish medical school, this is where I want to live, if you're going to be living in Kansas City. And we know how much effort people put into making sure that they have their house in a very good school district. So we're going to be talking more later on about that benefit later on. So also, so the project summary. So this is an B+ property in an A+ location. So A+ location where you have great amenities, or many of the homes in that area like are new, they're very safe neighborhood, and also, like we talked about before, very good school district. So the overview is the project itself cost about $50 million, and the equity needed to close this deal is about $15 million. And this is going to be about 3 to 5 year old, and we're going to be explaining that at a later time on why we have that timeline. So the annual return could be as high as 24%. It all depends on when we exit the deal. We always give it a range, right? Because it's very difficult to hit it smack at a particular percentage. And more importantly, I told our acquisition manager that if a deal cannot give us 2x, basically double our money in 5 years, don't even bring it. So this is always the goal, in that we want to make sure that we get into 2x multiple in about 5 years. Oftentimes we do it sooner, but that's the goal. So we're going to be talking about the different tiers of how you can get involved in this opportunity. Most people are going to be in the option 1, which is the 100K minimum investment. So you're asking about cash on cash. So we're going to be, I'm going to say, Richard, if you can keep compiling the questions.
Absolutely.
And then we're going to be answering it later. 100K, if you do 100K investment, so you're going to be Class A shares, which has 7% preferred return. And I'm going to explain what preferred return means, in that it means that the sponsor team don't get any return until they've given you this 7% return. So which means it protects you as an investor, and also it aligns your interest with the interest of the sponsor team, right? Because for us to be able to get also a good return, we need to overperform this, right, on the long run, to be able to partake in the return too. Also, it's going to be 70-30 split, which means the investors get 70% of the equity, and then percent goes to the sponsor and the GP team. And that's up to 18% return. Once you get the 18% return, then it goes to 50-50. These I like because it always aligns, your interest, right, with the GP team, because we want to make sure you get that 18%. We want to get to the 18%, so we also can partake in even a better reward. For someone who asked about the average cash on cash return, we have put a range, because oftentimes, in the beginning, your cash on cash, it will vary, right? It might be low in the first year, right, as you're renovating the property, raising the rent. But on average, we're aiming for that 7% average cash on cash, just right there. And option 2, for people that are bringing bigger money, obviously, there needs to be an incentive for you to do that. you're taking higher risk, so you should be getting higher return. This was going to be 8% preferred return, and it's going to be 80-20 split. The GP team is going to basically forgo some part of their own split and give it to those big check investors. And just the same thing, anything above 20% goes to 50-50 split with the LP and GP. Do you have anything to add, Brian?
Yeah, I think this is one of the more preferential deals that we put to our investors. We really, right now, we know that equity is tighter, so we incentivize our deals for our investors. So like Bayo mentioned, 7%, that's your basically an extra layer of insurance for you as the investor. You're getting paid 7% before any splits to us as managers. And then it goes to 70% to you as the investor. Sometimes I get asked, oh, so the sponsor is taking 70 and I'm the investor getting 30. The investors are actually getting the majority of the upside, as you should, because you're putting in your hard-earned money. It's no longer, the 80s when we're doing 50-50 deals back of the table. Investors have gotten more sophisticated, and we realize that, that's where the lifeblood of the operations, you're the lifeblood of making this deal put together. When you're doing any deal, you want to make sure that you as the investor are getting the preferential treatment as an investor. So, and like Bayo mentioned, two different share classes, both great. It depends on how much money you have or looking to place before the end of 2023. Because this will be the last, it's November, so this will 100% be the last deal that we do this year.
Yep, and we have to close. I think I'm hoping that it absolutely close this year, because then we can take advantage of the 80%, tax benefits. So
right, and we'll get more into that later in the presentation.
So, okay, so why do we love these deals? So this is divided into 4 categories. So we already talked about the school district. So if you have a number 1 school district, it's a no-brainer in terms of this will always continuously attract people to the area, right? And also the value of properties in that area continues to go up. And with that, it becomes very hard, right, for people to buy properties there. And if you want to be in that good school district, then you need to find other alternatives. And one of the alternatives is for you to rent, right? So that's where this rent versus own spread thing came into play, which means it's far more expensive for you to buy than to own. So and they all go hand in hand. The other important part of this is the low risk debt. Like we said, if you're going to do any deal right now, and you're going to put it at 8.5% interest, or even 9% in some cases, it's going to be very difficult to make it work, at least to cash flow. You might finally do well on the long run, but you're going to have to stay in that deal for many years. So this is a 3.9% assumable loan. So we've been looking into this kind of deal all year. So, and I'm very glad that we're able to find this one. Another thing is this is already running, right? This is already operational. So with watercolor, people that are in with the deal with us, it's a different kind of deal in that it was mid-construction when we acquired it. So phase 1 and phase 2 closed, and then the phase 3 closes 6 months after. So it's going to have to take some time for you to lease it up. But this is already over 90% occupied. The current owner are already raising rent, and in some cases, even above the pro forma that we have. Again, why do we love Overland Park, right? There's many A pluses, A's. There is a class A plus area. And it's a very good place for family and young professionals. I actually think Kansas actually is a great place in general to raise, Midwest in general. Great place to raise family and to raise families. But this area, where it's a very safe neighborhood, right? So that's where you want to be. So it's one of the best places to live in Kansas. And also, we're going to talk about the kind of jobs that are in the area that can give you some idea of the kind of people that's going to be living in the area. So this is just about the rent versus own spread that I talked about early on. So it costs you about 53% more to own a home than to rent in Madison Overland Park. And that's usually the case in many of these sought after areas. Okay. So talking more about the rate of the debt. So like I said before, in an inflationary environment, right? So if you have an interest at 3.9%, even though the inflation continues, right? You get to have that fixed debt for that period of time that you have it, right? So it gives you enough time to work on your business plan. Most of the time, we work on our business plan and we achieve it by 18 months, maybe 2 years, right? So once you have that enough time to raise the rent, stabilize the property even further, you're usually able to get a better rate. There's those loans called the DSCR loans, where you can actually get a much, much better debt, even if you're going to refinance. So I'm going to give it to Brian to kind of talk a little bit about the business plan.
Yeah, absolutely. The business plan here, you can see it laid out here. We have about $2.8 million of CapEx budgeted for this property. So you'll go through some of these pictures. You can see it's a B community because it's built in 2000, but in an A area. It really has this community feel to it. When I was there at 8 a.m. and the school bus route actually goes through the community and picks up multiple kids from each stop within the apartment complex. So it doesn't just stop at the front of it, it goes through it because there's so many families in this community. And that's what we're really coming in here to do, is increase that curb appeal, drive net operating income, which is ultimately how you evaluate an apartment complex, and why we like apartment complexes so much more than single family, where you have those fundamentals of single family rentals, but you have the economies of scale and the valuations of commercial real estate. So that's exactly what we're doing here. So 83 of these units we're going to be doing a full renovation on, and that's going to be with our in-house construction team. So we feel really very good about these numbers. We're not outsourcing that. So right now on the property, there's a $500 difference between unrenovated units and renovated units. So we see a great opportunity to go ahead and renovate those units, gives the residents a nicer place to live, but ultimately increasing the net operating income so we can achieve this 3 to 5 year goal. Right here, you can see a couple other fine tuning items, some garage doors, exterior doors. We'll add some more space to the playground, some pool furniture, upgrade the leasing office, and car wash, dog park, small things to really continue to give that community feel. Another amenity here with a pool, and of course, pickleball. We're going to add a pickleball court to the facility. That's all the rage right now, and everybody loves that. Very inexpensive item to add. When we're looking at these items, we want to see what's our return on investment, and we want to make sure that for every dollar we're spending, we're getting it above what we're projecting on net operating income. So that's going to be the business plan here at Madison. You can see right here, so these are some of the classic units. They don't look terrible. It's just an outdated feel, something you might see at your grandma's house or something like that, with the older cabinet feel. But then on the bottom, you can see some of the renovated, you can see some of the plans here. So we'll do LVP throughout the wet areas, ceiling fans in the master bedroom, stainless steel appliances, add some USB outlets, and repaint it from that yellow to more inviting color there. Let's see, here's the exterior. So you saw in that first picture, really nice community sitting right in Overland Park, Kansas. If I was going to live in Kansas City, this is where I would live, in Overland Park. This is where everything is buzzing in the area. But so for the exteriors, we've got some light work to be done there. Some of the roofs patching and then sprucing up the exterior there on the brick, power wash the brick, replace the irrigation system, really give a long-term feel to it. Here's some of the amenities we plan on using. The gym there stays super busy. It's a small little gym and it's painted yellow and blue. I don't know who painted that. I'm not a big design guy, but I'm not the most inviting there. So the rechange the colors there. We're actually going to open up this pool area in the back. It's small for a 200 unit townhome community. So we're going to expand this back here, give it more space. Right here, you can see the dog park down there. And then there's a lot of open space. So this is actually at the bottom of the property. So we'll actually be adding the pickleball court right here to the right of the dog park, away from the center of the community, where center of the community might pick up on the sound there. And here's the playground that gets a lot of use with the families there. So we're going to make this playground a little bit bigger and really spruce that up for the community. And this is something that we're going to do immediately upon takeover. So the residents know that new ownership is here and we're not just increasing rents just to increase rents. Yes, costs of insurance and taxes are going up, but we're coming in and justifying for those rent increases and making people feel more happy to pay for those increases.
Yep. Just like I remembered it. And Richard and I are actually going to be going there on the 11th. And we actually have Danny. He actually lives there right now. Danny, are you able to come on?
Hey guys, can you hear me?
Yes, we can hear you. So, hey, Dan is a cardiologist in Kansas City right now. The first guy, I was like, man, can you drive over there? Take a look quickly, where the first came to on our desk. So, what do you think?
Yeah. So I've actually no sort of relationship with this Dr. Breezy Financial. Hold on, Sophie, can you give me a second? Sorry guys. My kiddos are here. When he had told me about this potential area, I told him, hey, look, Adebayo, I live like about 5 minutes away from this area. And I told him, I did my residency and everything here. Actually, Adebayo and I did some training together here. And what's interesting is that this area is where all the physicians end up living. Once you have a wife and kids, you move to Overland Park. That's the suburbs. Overland Park is sought out because of the Blue Valley District School. And so that's something that we all look at as young physicians, family. The other thing was it's kind of interesting, and I told Adebayo about this, is that it's really that intersection is where everybody wants to stay because all the good shops and entertainment, everything is there. And it's close to a highway, which is essentially gonna, with the re-end of the highway there. But so good access to downtown if need be. It's a great place. The other thing that I noticed in terms of the population group, the families with kids are there, but also a lot of workers, like tech industry workers who may not have a family. That makes up some part of the population here as well. Some of them are my friends, and they tend to rent than buy, and so that's what I've observed. I don't know if I can answer any more questions, but about the property, but I can answer more questions about the city.
Okay, thank you. You definitely confirm our information, right? So I live there also, but just wanted to, sorry for springing this on you. Thanks.
Yeah, no worries, man. No worries. Yep.
So, and I'm going to answer your question. He asked about why are the current owners selling? I believe is that they have multiple properties. They have thousands of units, and the Madison Overland Park is the only one left in this region. So it puts an operational burden on them. And so they would rather just focus on the market that they are. But for us, Aspen Group have about 300 million assets under management, and their base is actually Kansas. For us, we already have a team member that basically focus in this area. So it's going to be much easier to operate, right, for us.
And back to your earlier point, Dr. Fasanya, is we have experienced hurdles in the past with outsourcing management. And so, as Brian alluded to earlier, having management in-house and being local will allow us a great deal of control over the operation, especially as we look at ways to improve the amenities that will lend itself to make the increase in rent more palatable for the residents.
Yep, that's true. And Brian, any addition?
Yeah, those are all good points. And I think we'll be talking more about that throughout here. Yeah, it's their business plan is over that, but we're looking for opportunities that we can come in and find where the previous owners did not continue to add value. You can see that they didn't account to renovate those extra 83 units. They had all of these units completely classic. So there was immediate upside right there from taking those to the current market value.
Yep. So a little bit more about the Midwest, to be honest. After Danny already talked about it, it's going to be very quick. It's top 10 for most things, right? So best place to rent in the country, best city to raise a family, best place to live, where to start a career, and remote workers. It's all the rage now, too. It's basically all-rounder, a very good place to be. We basically almost beat this to death, but economic growth, right? Panasonic, this one is very important. They're investing $4 billion in the surrounding area, right? And that's going to create about 4,000 jobs by 2025. This is not like 2035. This is just in the next couple of years. And that's within when our business plan is, right? We also, I think there's Meta, right? I was reading about an article about Meta, also expanding into Kansas City area. A lot of companies are coming in here. And the thing is, these companies, they do their research. So all you need to really do is follow where the people are moving in terms of where are the tech companies going, where are the healthcare companies going, and then you'll be successful. So I like the mixture of employers. So you want to invest in places where you have healthcare. It's always a very durable business. Richard can attest to that. So he's in the healthcare business a lot.
It's a weird hybrid between government subsidized and for-profit. So it lends itself to almost, I don't want to say recession proof, but higher probability of success even in economic downturn.
Yeah, because if you're sick, you need to get healthcare, right? So it's not something that can wait. And also tech companies, you want to see where the tech companies are going. And like Danny said, many of the people working in these tech companies are usually young adults, many of them even without family, but they love a very safe area, a safe neighborhood, and places where they just want to do their job and also just mostly stay home doing remote work. And also they have the amenities that are very close to them, so they don't actually have to travel that much. So that's that kind of new lifestyle for the younger adults nowadays. So this is even a bigger overview, right? Of a lot of retail area, lots of employers. So it's endless supply of renters for this property. And since it's a sought out area, so they'll pay the money just to make sure they don't have to go to private school, which is going to be more expensive. So to put their kids into the #1 school district. So I'm going to give it back to Brian to go over the financial analysis, and then we're going to start rounding up.
Yeah, absolutely. We talked a lot about the sponsorship team, which is super important before you do a deal. You want to make sure you're riding with the right group. They've got the experience and they have the advantage. And you talk about the market. You want to make sure the market dynamics are there. Population growth is great. Job growth is great. Being on the top 10 list is great because people move there and then they stay there, like Danny did. It creates a stickiness to the market where job growth and population are great, but when it becomes a nice place to live, people end up staying there for longer term. So we talked about the sponsorship team, the market, and one of the more important pieces is a financial analysis. So how are we getting to these 2x returns? How does it look like on our business plan? How has the property been performing the past 12 months? And how do we expect the property to perform after we take over? So that's exactly what we're doing here. To get to those, we're looking at, okay, what are the current rents? What do we expect them to be? And how are we getting that delta there? So we talked a lot about the CapEx plan. and how we're going to be completely renovating quite a bit of that. You can see here, there's quite a bit of a delta between the rent and what we can achieve post renovation. Here is the average of the comps. Madison, you can see right here, Madison is highlighted in blue. And then we have up here is what rents have been previously. There's already almost a $200 delta just in these 2 bedrooms, $300 delta here in the 3 bedrooms. And when we're taking a look, one of the best places is, yes, it's good to look at comparable properties, but one of the best ways to really see is, especially on a value add plan like this, is look at rents that units on the property that have already gotten renovation. So you can see right here, some of these renovated units are getting more than what we're projecting. So we want to be, it's great to say I can 2x your return, or I can get you 20% average annual return, but to be able to actually conservatively underwrite that is another thing. So we want to be conservative when we're underwriting, just in case maybe they don't all pay for these new premiums. But this is one of the best cases for us right here, where you can see that we have unit 902. He's already paying $23.93. On pro forma, we have $22.50. Unit 1006 renting $22.74. On our pro forma, we have $22.50. 2603, 1966, and we have 1950. So right here, you can see that we're really underwriting the property conservatively, and there's really room for growth there. This is based on the September 19th rent roll, right after we got it under contract. Purchase price, recent sale, yeah. So this is really good information right here. We're purchasing it at 156 per square foot. This is relative, but it gives you a good basis here that recent sales comps are selling for 222 per square foot. So those guys, our local partners in the area, they were like saying this is a screaming good deal here when you're looking at these other comparable properties. Right here, we have two different projections. Right now, it is a 3 to 5 year business plan. Us as the partners are incentivized to come in and execute in 3 years. But if we aren't able to achieve where we're at on returns, we'll continue to hold that for another 2 years, for 5 years. Typically in the past, most of our business plan models have been 5 years, but we aim to achieve our business plan much earlier. But in the current market, it's hard to have a crystal ball to say where we're going to go. Personally, I think we'll be in a perfect time, 3-year exit. So we're closing December of 2023. So that's saying we'll exit in December of 2026. So that'll be after the $4 billion Panasonic facility is opened up, which they're already bringing 300 people a month in. Hopefully, interest rates will have started to come back down in 3 years, but we're not underwriting for that. But it's safe to say that in 3 to 5 years, we'll have some sort of really good window to exit. So here's the different projections. Here's what happens to your investment on the right-hand side if we do exit in 3 years, and then on the left-hand side for a 5-year exit. Here's some of those sales comparables that we were talking about. Over $20,000 per door difference in recent sales comparables. Really excited to push that for the next 3 to 5 years. Here you can see the sources and uses. So we are getting a fixed rate debt from Fannie Mae. We're assuming that Fannie Mae doesn't just let anyone, another point about this 3.9% assumable debt, Fannie Mae doesn't just let anybody assume their loans. You have to get underwritten and you have to get approved by Fannie Mae, which is very hard. You have to have the experience. So I think it speaks to us as the sponsors that they want us to come in and take over this loan. Right here, you can see this is going to be about $15 million of equity. You know, after we put this out with Breathe Easy, we've actually already had, some of you guys have actually already started to subscribe and sign up before this webinar, took a look at the investment summary. So this equity, I think we have less than 5 million left at this point. This preferred equity is 7 Acre. They're a Kansas City group. They're coming in. They're not participating in the upside. They're only getting a higher preferred return. So we're excited to have them on, and they're writing a $12 million check for the deal. So another reason that speaks volume to this deal is for someone to have that bandwidth to put $12 million into a deal really speaks to the strength of the deal. Here's the purchase price, closing costs, and the fees. Right here, you can see our 5-year pro forma. You can get a copy of this investment deck on the Breathe Easy financial portal. So you'll be able to go in there, download this investment summary if you guys really want to get deep and dirty with the numbers here. And then this is what some of our stabilized assumptions are going off of. One more point too here. You can see right here, we're really conservatively underwriting this, and this is through experience. Yes, we're increasing the rents quite a bit, but we have a loss to lease of 18% and a vacancy loss of 10%. We really don't think that will happen, but on paper, your numbers are projected based off this, and this is to account for as we increase rents, if we want to ask for concessions for people to come in. Yes, we're increasing your rent, but we're giving you a bonus to come in for that first year, and then expecting some people to move out.
Yeah, I'm going to add to that. So where you underwrite and you're underwriting for about loss of 20, maybe basically essentially 72% occupancy. And it's currently over 90% occupied currently. I think speaks to the testament for the underwriter, for the team that underwrote it, that they're very conservative. And also there's some money lost to bad debt, and not only in the first year, now second year also, it's about 17%, and it's estimating that by year 3 is when it's going to be stabilized. I really believe that it's going to be stabilized to be 5% vacancy within the first 18 months. That's usually the plan. It's better to underwrite for the worst case scenario. Yeah, I like it.
Here's some sensitivity analysis. So when we're going into a deal, we want to see best case scenario, worst case scenario. So you can look at this in the investment summary. What happens if the market gets looser over here? Cap rates continue to increase, or what happens if cap rates start to come back down in 3 to 5 years, which very well could. Your projected returns would go even higher here. So if the market started to get really good, you can see some really nice annualized returns here. But based on our projections, this is what we're saying. Conservative underwriting wise, right here, you can see in 3 years, you're getting a 22% average annual return. In 5 years, 20% average annual return. Majority of this is coming at sale. That first year is when we're coming in and spending that almost $3 million of money. And we're also accounting for 28% economic vacancy. We try to be very conservative here, but us as the GPs, we are more incentivized to come in and execute this business plan, like Bayo mentioned, and participate more in the promote with you. So here you can see $100,000 in, you would get $165,000 back if we sold in 3 years. 5 years, getting just about $200,000 back. And this is based on this current underwriting. So if we do come in and the market gets better, this could be even higher. But as of now, this is how we want to project it. This is how we want you to expect your returns to shake out. So you can see this is a total $15 million LP contribution. We've already had quite a few guys have already reviewed this investments and the syndication doc, and we have less than 5 million left on this. Really good to see these kind of returns. This is not what you're seeing in the current market. I know you see a lot of deals when brokers send you the pro forma, they're saying, oh, vacancy is going to be 5% or 0% even. Sometimes they don't even put it on there, or expenses at 20 or 30%. Those inflated pro formas. So we really like to dig in and find good value deals. And this will be Elevate's third deal of the year. The first deal being watercolors, which a lot of you guys got in on. So we wanted to do 12 deals this year, and here we are on our last deal of the year being our third deal. So I'm really excited again to be bringing this one for you. So here's a $500,000 investment. You can see a little bit higher returns on this with you getting a higher promote. One of the reasons why a lot of investors are looking at this deal too is the depreciation. So we will be closing in 2023. So 80% bonus depreciation this year. Next year, it's going down to 60%. The year after, it's going to 40%. So we're doing a cost segregation here. And so for every $100,000 invested, we're expecting approximately 77 in year one depreciation.
That's very high. What do you say, Richard?
That's very high. That's very high. Yeah. In
So
this market, in this climate, that's a really good return.
Yeah, for 146. So you're basically getting more depreciation over the next 5 years than how much you're putting into it.
That's correct.
So, yeah.
Which, from a tax standpoint, it's extremely beneficial.
So we've slowly put this deal out, and we've got a lot of interest. I think a lot of investors have been sitting on money right now and realize that their money is losing to inflation, and this is a great deal to put that investments in. So we've started to take commitments. The syndication documents are in the portal, so that it is going to be first come, first serve based on commits and then eventual wires. Right now, we're scheduled to close December 20th. We are taking investments now. Wire instructions will actually be up tomorrow, but all these syndication documents just got uploaded today. So what happens after you close on the deal? You'll be getting monthly updates at the end of each month, usually around the 25th to the 1st of the following month. Then we'll be giving K1s, so that bonus depreciation. Some of you guys will be getting multiple K1s from us, from watercolors and for this deal, and possibly the Fort Smith deal as well. And 24/7 access. You guys can reach out to me anytime, bayo as well. So we try to make ourselves available for any questions.
Okay. Yep. So do you will have any questions? I don't see more.
Yes,
questions.
I'll start with the questions that's in the chat board first, and we can go from there. So Robert, what is the cash on this deal?
Yes. So we went over. So cash on cash it ranges right from 4 to 8, but we're looking at average about 7%.
Okay. And I have two questions here from TJ. The first one is, how long has the current operators managed this project?
The current owners have had it for over 6 years now. So they were the first ones that bought it from the original developer. So actually, I guess that would be closer to 8 years now.
Perfect. And his next question was, what happens after the 4% 3-year or 3.9% 3-year assumed loan? What happens if we can't exit in 5 years?
Yeah, so after 3 years, we have two choices. We can either sell the property or we can refinance the property. So at the end of 3 years, December of 2026, we'll take a look at the property. And actually before that, every year after we purchase a property, we're getting broker's opinion of value. We're evaluating where the market's at. So we're going to be starting evaluating that starting next year. We're going to be looking at where the market's at, how much net operating income we've improved. So at the end of year 3, we're going to take a look and see, can we hit these projections in year 3 and sell the property? And if not, we'll go ahead and refinance the property. We've already added our CapEx. We'll have put in $3 million into the property. We would have added tremendous amount of value. So we'll refinance the property, do a cash out, provide you as the investors some of the cash from the refinance. You'll still stay in the deal at your same percentages, and then we'll hold it for another 2 years and sell it for that 5 years and try to double it then. If for some reason still in 5 years it doesn't look good, we'll continue to hold. So when we're doing that cash out refinance, we're making sure we're going to get locked in with a really good debt product to forecast out for at least 2 to 5 more years. But really, I think we're already being conservative at the 5-year hold. I think realistically, us as operators, we're going to try to come in and knock it out of the park in 3 years. But worst case, we'll hold it for 5 years. And worst case scenario, we'll continue to hold until it's more profitable for our investors.
Yeah, in general. So that's real estate is awesome in every single area, except that your money is locked in. So that's one thing you want to know about that. So let's say in 3 years, like Brian said, and it's not a good market to sell. But one good thing is it's going to cash flow. If it continues to cash flow, then you're okay. You're able to pay the bills. So you can hold it, for longer rather than selling for a loss, right? So that's usually, so that's the decision made by the GP team to be like, okay, maybe we'll hold for a few more years. And yeah, there are situations where you might have to hold longer, but oftentimes we've actually been able to exit earlier. That's usually the case.
And for those of you guys who are late to this meeting or want to access the documents, you can click on the presentation and stream to access the portal, as well as in the chat, Dr. Fasanya has put the portal link, and so you can go there and view as well. So don't hesitate to reach out. Also, as Brian alluded to earlier, we're available to have one-on-one session, answer Q&A as you guys go through this process. So you can always reach us via the portal, and we're happy to schedule a time to meet and discuss any questions you may have about this specific deal or any other deal in our portfolio.
Yep. So let me put Bayo at Dr. BDZ, and also Richard, same thing, Richard at drbdz.com.
Absolutely. And we want to say again, guys, thank you all for your time. We know your time is very valuable, and so we want to be mindful of that. Again, it's the reason why we have a chat here. Our emails are pretty simple. Feel free to reach out anytime should you have any questions about this deal, and we'll be happy to schedule a time for a one-on-one session to discuss.
Sure. No, if there's no more questions, then we're going to just thank everyone for coming. Thanks, Brian. I know you've been making a lot of appearances. I've been seeing your videos, and you work hard, and that's one of the reasons why I like working with you. Thanks, Richard, for coming. I know you have about 10 different businesses to attend to. Thank you, everyone. And also, thanks everyone for coming. And if you want to continue the conversation, email us. Again, on the portal, you can download the slide deck and go over it yourself. We can go over it with you. And it's first come, first served. Some people already committed because I sent the information to them. They already have a trust in our team. Okay. See you guys. Thank you.
Appreciate it.
Yep.
Have a good evening, everyone. Thank you.